Imagine investing your life savings, then waking up the next morning to find that nearly half of it has disappeared. It sounds like a nightmare, but it's happened before. Not once, not twice, but many times throughout history. Yet here's the surprising part. Every major stock market crash has also created some of the greatest investment opportunities ever seen. So, what can these crashes teach us? Let's find out. The stock market has experienced some dramatic crashes over the past century. While each one was caused by different events, they all share one important lesson. Markets fall, but they also recover. Understanding these crashes can help you become a smarter, calmer, and more confident investor. Let's look at 5 of the biggest stock market crashes in history, and the valuable lessons they left behind. Crash number 1, the Great Depression, 1929. The stock market crash of 1929 remains one of the most devastating financial events in history. During the Roaring Twenties, stock prices soared as investors believed the market would keep rising forever. People borrowed money to buy stocks, expecting easy profits. But when confidence disappeared, panic spread quickly. Investors rushed to sell, causing stock prices to collapse. The crash triggered the Great Depression, leading to massive unemployment, business failures, and years of economic hardship. Markets can become dangerously overpriced when greed takes over. Never invest based purely on hype or the belief that prices can only go up. Crash number 2, Black Monday, 1987. On October 19, 1987, global markets experienced one of the largest single-day drops ever recorded. The US stock market lost more than 20% in just one day. Fear spread rapidly, and automated trading systems made the decline even worse by triggering massive sell orders. Many believed it would take decades for markets to recover. But surprisingly, the recovery happened much faster than expected. Short-term panic doesn't always reflect long-term value. Selling out of fear can often be one of the most expensive mistakes an investor makes. Crash number 3, the dot-com bubble, 2000. During the late 1990s, internet companies became the hottest investments in the world. Many businesses with little revenue, and sometimes no profits at all, were worth billions of dollars. Investors believed every internet company would become the next big success. Reality eventually caught up. When expectations proved unrealistic, stock prices collapsed. Thousands of tech companies disappeared. A great story doesn't always make a great investment. Always look beyond the excitement and focus on a company's fundamentals. Crash number 4, the global financial crisis, 2008. The 2008 financial crisis began with the housing market. Banks issued risky mortgages to borrowers who couldn't afford them. As home prices fell, borrowers defaulted, and the financial system began to unravel. Major financial institutions failed. Stock markets around the world plunged. Millions of people lost jobs, homes, and retirement savings. But investors who stayed patient and continued investing during the downturn were rewarded as markets recovered in the years that followed. Market crashes are temporary. Panic is permanent only if you sell. Patience often becomes an investor's greatest advantage. Crash number 5, the COVID-19 market crash, 2020. When the COVID-19 pandemic spread across the world, uncertainty reached historic levels. Businesses closed. Travel stopped. Entire economies slowed almost overnight. Stock markets fell at record speed. Many investors feared another long recession. But governments and central banks responded with massive economic support. Markets recovered much faster than many experts expected. Some even reached new all-time highs within months. The lesson. No one can consistently predict the market. Trying to time every rise and fall usually leads to poor decisions. Staying invested often beats trying to guess what's coming next. What every investor should remember: every market crash looks different, but the lessons remain the same. Markets move in cycles. Fear and greed drive short-term prices. Diversification reduces risk. Investing consistently beats trying to predict the perfect moment. And perhaps most importantly, every major crash in history has eventually been followed by recovery. History doesn't guarantee the future, but it reminds us that patience has often rewarded disciplined investors. Stock market crashes can be frightening, but they're also part of investing. The greatest investors don't avoid every downturn, they prepare for them. They stay calm, stick to their strategy, and focus on the long term. Because in the end, wealth isn't built by predicting every market move. It's built by staying invested through the ups and downs. If you enjoyed this video, don't forget to like, subscribe, and turn on notifications for more videos on investing, personal finance, and building long-term wealth. Thanks for watching, and I'll see you in the next video.